Welcome to The Explainer. Today, we're diving into a truly incredible real-world portfolio breakdown. We're going to look at how one focused, long-term investor navigated the first 7 months of 2026, combining a massive surge in capital with a relentless passive income engine. If you've ever wanted to see under the hood of how wealth actually compounds month over month, you are definitely in the right place. So, let's jump right in.
Here's a quick look at our roadmap for today. 1. The 808K portfolio surge. 2. July's passive income engine. 3. The dividend snowball strategy. 4. Taxes and emergency funds. And 5. 7 new July investments.
All right, kicking things off with Section 1, the 808K portfolio surge.
Picture this. At the very beginning of 2026, this particular portfolio, which is made up of about 30 individual companies and 5 ETFs, was sitting at a baseline of roughly £690,000. Fast forward just 7 months to the end of July, and that figure has climbed to a staggering $808,000. Now, while seeing that raw capital increase is absolutely fantastic, the real magic, as you'll see in just a minute, actually lies in the passive income generated along the way. But first, let's put this capital growth into perspective.
The breakdown of this growth is super interesting. The investor didn't just sit back and watch. They actively injected about £20,000 of fresh money from their wages and savings during a significant market dip earlier in the year. It's that classic contrarian mindset, looking for opportunities when the market is fearful. But even after accounting for that new cash, the portfolio still achieved a massive net gain of close to $100,000. That is literally a 14.1% increase in just 7 months. Of course, quick reality check here. These are unrealized gains. The investments haven't been sold, so this profit is purely on paper based on current market values.
Moving right along to Section 2, July's passive income engine.
Okay, let's look at the actual cash hitting the account, because every major dividend payment in July is just a beautiful sight. We start with some smaller but solid contributions, £30 from Sage and $55 from Experian. Now, both of these have seen their share prices take a bit of a hit recently due to AI concerns, but they still boast really strong long-term dividend growth. We've also got £60 from Bunzl, a company that's up over 35% this year alone. Then the ETFs start kicking in. £60 from the global VWRL, £100 from the developed market VIV, and £135 from a high-dividend global ETF. Toss in £85 from the cyclical house builder Persimmon and £185 from GSK. Getting these tangible quarterly payouts from such diverse global companies just makes the whole investing process feel so real, you know?
But you absolutely cannot ignore the elephant in the room here. National Grid completely dominates the month with a staggering £720 payout. I mean, wow. When you combine that massive payment with the £295 from the ETFs, £415 from the other individual stocks, and a cheeky £50 from premium bond prizes, you're looking at a grand total of approximately £1,480 in gross passive income just for the month of July.
And this right here perfectly illustrates the sheer power of time in the market. Check out the current portfolio yield. It's sitting at about 2.6%, which is actually slightly lower than the broader FTSE 100 average of 3%. But look at the yield on the original investment. Because this investor has been playing the long game for years, allowing these companies to steadily increase their dividends over time, the yield based on their original invested money is now an incredible 6.5%. That is the ultimate reward for patience.
That brings us to Section 3, the dividend snowball strategy.
Let's define this clearly because it's absolutely crucial. The dividend snowball is simply the process of reinvesting your dividend income to purchase additional shares, which in turn generate even more dividends over a long period. Think about it. This investor could easily take that $720 from National Grid and just blow it on a nice holiday or a new gadget, but they don't. They put that income right back to work in the market.
Basically, it all comes down to a super simple 3-step cycle. Step 1, you receive the dividend. Step 2, you use that cash to buy additional shares. Step 3, those extra shares generate more dividends in the future. Sure, the income starts out pretty small, but over a long enough timeline, this reinvestment loop gradually and powerfully explodes the amount of income being generated. It's honestly one of the most motivating strategies out there for everyday folks trying to build serious wealth.
To really cement how effective this is, listen to this real-world anecdote directly from the investor. I've actually held National Grid for more than 16 years. Over that entire period, the company has paid me approximately £9,500 in dividends, almost 10 grand. That is exactly what the snowball looks like in practice. Patience and compounding pay off tremendously.
All right, Section 4, Taxes and Emergency Funds.
Managing an 808K portfolio isn't just about picking stocks. You've got to deal with account limits. It requires a strategic balancing act between a tax-free stocks and shares ISA and taxable non-ISA accounts. Luckily, the vast majority of the investments are wrapped safely inside the ISA, shielding those dividends from tax. But because you only get so much ISA allowance every year, two global ETFs, VWRL and VIV, had to be placed outside the ISA in taxable accounts.
And since those ETFs are sitting in a taxable account, the taxman inevitably comes knocking. But here's the crazy part. Out of the £1,480 in gross passive income generated in July, the tax bill was literally just £40. That leaves a highly respectable net income of roughly £1,440 for the month. Actually, when you zoom out and average the whole year, factoring in pandemic recoveries and dividend growth, this investor is currently bringing in about £1,679 per month, on average after tax.
But beyond just optimizing for taxes, we have to talk about playing defense. This investor uses premium bonds, which are uniquely British savings products, as their emergency safety net. Why? Well, if they suddenly needed a massive chunk of cash during a market crash, the absolute last thing they'd want is to be forced to sell off shares at a loss. Keeping cash outside the market provides totally accessible funds. Plus, premium bonds offer a 3.8% headline prize rate, and every single prize is completely tax-free. In fact, in July, this safety net yielded 2 small wins totaling £50.
Finally, Section 5, 7 new July investments. So what were they actually buying? The July shopping list is a fantastic mix of broad diversification and targeted contrarian stock picking. We've got the pharmaceutical giant AstraZeneca, the cyclical house builder Persimmon, and defense contractor BAE Systems. They also added heavily to their S&P 500 ETF and a developed world ETF, which gives them that low-cost exposure to hundreds of global companies. And to top it off, they picked up more shares of the banking giant HSBC along with IG Group. Now, the big through line across all these purchases is the investor's psychology. Take AstraZeneca, for example. The investor first bought it way back in 2009 at around £28 a share, and today it's trading above £120. Or look at IG Group. Their share price recently tanked after acquiring an American business. While short-term investors panicked and sold, this investor saw a golden opportunity to buy a great underlying business at a massive discount. Investing really isn't about predicting what the market will do next Tuesday, it's about holding quality assets with a long-term horizon.
Which brings us to the big thought I want to leave you with today. When you look at this 808K portfolio, it wasn't built on panic selling, and it certainly wasn't built on chasing overnight trends. It was built on relentless discipline. So ask yourself, are you reacting emotionally to short-term market shifts, or are you patiently building your very own dividend snowball? Thank you so much for joining me on this explainer today. I really hope breaking down these numbers helps you refine your own financial journey. Keep learning, stay patient, and I'll see you next time.